Hi, we're Group 110. My name is Brandon Basson.
I'm Greg T.
And I'm Nick Holding. We also have a fourth group member, Hamish, who lives in Geelong and currently can't be here today. The following presentation is an in-depth analysis of the ASX-listed firm Woolworths Group. Throughout, we will analyse and discuss different aspects that affect the operations of Woolworths Group and conclude with a valuation and recommendation.
The Woolworths market price fluctuates. Throughout the report for consistency, we have used closing price as of August 26, 2019, which is $35.67. Woolworths is a large Australian corporation that expands operations to within New Zealand as well. Founded in 1924, the food, retail and consumer staples firm is listed on the ASX Stock Exchange under the stock ticket WOW. Woolworths Group encompasses a large range of differing strategic business units, with their Australian and New Zealand food sector being the largest with 76% of their revenue. This is followed by Endeavour Drinks with 14.5%, Big W with 6% and their hotels with 3%. Woolworths strive to deliver the best convenience, value and quality for their customers. After conducting a comprehensive research and analysis into the valuation and operations of Woolworths, we recommend a sell status on the stock. We will discuss the reasons as to why throughout this presentation. Through our analysis, we found that the consumer staples industry, including that of Woolworths, are currently within the mature stage of their industry business life cycle. This is due to the company experiencing a declining year-on-year revenue growth percentage compared to the early stages of their existence. New demand for innovation can prolong this stage as consumers are demanding a stronger online presence. The industry was dominated by a duopoly, with Coles and Woolworths dominating the market share. Whilst they still retain a strong hold on the industry, new competitors such as Aldi are gaining market share, forcing the industry into becoming an oligopoly. Furthermore, due to the nature of the industry, Woolworths is a defensive stock within a non-cyclical industry, as there is a constant demand for groceries regardless of the economic conditions.
Being a large, market-leading corporation that expands over several business units, Woolworths inherently face a plethora of risk factors. These risk factors arise both internally and externally, while some are within their control, others are not. Woolworths have a strong brand reputation, built on decades of trust and honesty. Therefore, the potential of their reputation being compromised is of significant risk to Woolworths, as it would result in detrimental consequences. Being found guilty to a series of class action lawsuits that they are currently facing would not only manifest media scrutiny, but would also create doubt in shareholders' minds. In addition to this, another internal risk factor is the potential of hiring ineffective management who are incapable of making correct strategic decisions. Both of these are within the company's control. However, risk factors such as domestic and foreign currency volatility, as well as tariffs and competitors' operations, are out of their control. Currency volatility and tariffs affect Woolworths' ability to import and export goods, whilst the decisions made by competitors may affect their market share within the industry. The RBA's decision on cash rate and inflation rate changes affect Woolworths' ability to repay borrowings and therefore impact the level of debt they will strategically accept to fund operations. Further to this, even though Woolworths operates within a defensive, non-cyclical industry, household and capital expenditure affect Woolworths' revenue. Therefore, the possibility of changes in these risk factors are of significant risk to Woolworths.
With ratio analysis, we looked at Woolworths' liquidity, asset management, leverage, profitability, and market price ratios. To understand Woolworths' liquidity, their current and quick ratios were used. This indicated a consistent downwards trend, which suggests that Woolworths may struggle to meet short-term obligations. Woolworths' asset utilization experienced mixed results, with a slight improvement in the inventory turnover ratio, but a strong decline in the total assets turnover ratio. Compared to Wesfarmers, however, which had a ratio of 2.21, Woolworths had a comparably better ratio of 2.63. Debt to equity highlighted a relatively stable rate over a 5-year time span, which indicates a consistent level of debt being used to finance operations, with an average of 1.27 This indicates that Woolworths may be over-leveraged. The TIE ratio achieved suggests that Woolworths has limited issues with covering its interest obligations. An operating margin of 6% is decent compared to the industry average of 6.2%. The net profit margin and operating margin, however, are both on a downtrend. Finally, through the price-to-earnings ratio, we were able to determine that the company does not receive an advantageous level of earnings compared to the amount of shares they have in circulation. This is yet another leading indicator that may suggest that Woolworths are overvalued. Also, it should be noted that both the PE and market-to-book value are projected to increase.
This absolute valuation shows the possible values of Woolworths Group based on potential cost of equity and growth value numbers. The expected cost of equity is 12.19%, calculated by using the average risk-free rate and risk premium of the market over the past 10 years. The expected growth rate is 4.87%. This is the earnings growth taken straight from the Woolworths profile on the CommSec platform. As you can see, the absolute valuation is $13.07. It gives a range between $7.62 and $22.58 over all potential outcomes. This graph illustrates the previous slide's figures. As you can see, all possible scenarios indicate that Woolworths is currently significantly overvalued at its trading price of $37 to $39. This table shows Woolworths Group with its main four sector peers, who together make up the largest portion of the consumer staples sector, and as such their financial figures will be compared and discussed to achieve evaluations, being Coles Group, Treasury Wine Estate, the A2 Milk Company and Coca-Cola. This focuses on the enterprise value/earnings ratios and the price/book value ratio for the valuation, which will be discussed on the next slide. This graph plots the two focused on ratios from the previous slide for each firm. As a general rule, the lower each ratio is, the more undervalued the firm is, and as such, the closer to the bottom left-hand side of this graph, the more undervalued it is relative to its sector peers. This graph indicates Woolworths is fairly valued within its peers, and as such, the relative valuation concludes its value is its current market price of $37. To conclude, the absolute valuation indicated a price of $13.07. The relative valuation indicated a price of $37. Weighting them both 50%, the final valuation is concluded as $25.04. Woolworths is currently overvalued at $37 to $39 for its market price, and as such, we give a sell recommendation. After our in-depth analysis of multiple aspects, we conclude that Woolworths Group is currently overvalued and therefore give a sell recommendation.
Thank you very much for watching, and we look forward to hearing your feedback.